This is a brief explanation of the Executive Security Plan exhibit found in the modeler. In order to get to the Executive Security Plan detailed exhibit, you can click on the red button at the bottom of this input screen. Alternatively, you can see that there are various worksheets within the modeler workbook, and the one that we'd like to look at is the ESP with split dollar. So the detail exhibit has three main sections to it. In the first section, we can see the contributions that are being made to the Executive Security Plan. So the executive's contributions to the ESP, in this example, given the inputs that I've entered, would be $58,000 per year from age 45 until age 64, 20 years. Because these contributions are being made on an after-tax basis, they're subject to income tax. And so, given the 40% income tax rate, there would be a total of $23,200 worth of taxes payable by the executive, so that after payment of those taxes, there'd be $34,800 available to contribute to the plan. Now, the Executive Security Plan calls for a tax restoration loan from the hospital or from the sponsoring organization. And so in order to restore taxes, the hospital would contribute $23,200, the same amount that was paid in tax by the executive, so that a total of $58,000 of total premium would actually go into the policy, partly from the executive and partly from the hospital. The hospital's share of premium would be established as a loan, and the executive would owe the hospital that amount of money at some point payable in the future at retirement. And as additional contributions were made to the plan, additional loans would be made so that the loan balance would continue to go up throughout the individual's working career. The loan would be treated as a interest-bearing loan, and therefore the executive would owe interest at the applicable federal rate. And for this purpose, we're going to use the demand loan rate, or short-term AFR. Right now, that short-term AFR is very, very low. It's about 59 basis points. Historically, the rate has been higher, and so we're showing the loan interest rate going up 100 basis points next year, and then eventually going to more historic levels at 2.5%. So the executive would have imputed tax cost, which will be reported on his W-2, based on the outstanding balance of the loan times the applicable interest rate for that year. In the first year, therefore, that'd be $137 would be reported as additional income, and the executive's cost on that imputed income would be about $55, which is $137 times the tax rate of 40%. Over time, as this loan builds up, 5 years out, the loan balance would be about $116,000. At 2.5%, that would generate about $2,900 worth of additional reportable income, which would cost the executive about $1,100. At its peak, right before retirement, the loan balance would be about $464,000. At 2.5% interest would be about $11,600 of reportable income, which would cost the executive about $4,600. So it's a fairly modest cost, given the size of the death benefit that's in place, and given the fact that the executive has these loan dollars working for him or her inside the variable universal life policy. You can also see then in the last set of columns what's happening with respect to the actual policy. The executive's share of cash value would be about $38,000 at the end of the first year. That's based on a 7% investment return, and based on the fact that while there's been $58,000 of contributions made, a portion of those contributions are really due back to the hospital. So this is the executive's net share of cash value. The death benefit in the policy, again, given the executive age of 45 and the size of the contribution going in, would be $1,265,000. And then over time, as additional contributions are made, cash value is going up, death benefits going up. Then once retirement is reached, in this case at age 65, the executive would take a distribution from the policy to actually pay off or liquidate the loan. And so there's a $464,000 distribution from the policy at retirement that the executive uses to eliminate the loan. And you can see that the loan balance, once retired, is zero. And no more imputed interest and no more tax costs for the executive. The executive then, in addition to taking distributions to pay the hospital, can then also take distributions for him or herself from the policy. And in this case, over a 20-year period, that would be about $136,000 worth of non-taxable income. Again, one of the benefits of an insurance policy is that the first dollars taken out are typically treated as basis, and then from that point, once basis has been pulled out, the earnings in the policy can actually be borrowed from the policy and would not generate current income tax. At the end of 20 years, we're assuming death age 85, there'd still be a $459,000 death benefit, and so you can see the total distributions to the executive on a non-taxable basis would be about $3.1 million. So that's a quick overview of how the executive security plan works in detail.